Tax season is in full swing, and as inflation continues to hit Americans' finances hard, most of us are looking for a way to lower our tax bill or maximize our returns. To help offset inflation, the IRS updates over 60 tax provisions a year. So whether you've filed already or are still getting your numbers in order, here's what's changed this tax season and what to expect. For starters, how you file may change. Many Americans use platforms like TurboTax or H&R Block, which have free tools but can end up costing a bit of money. MarketWatch reporter Andrew Keshner recently joined the podcast On Watch by MarketWatch to discuss more.
We see these ads, we can do your taxes for free. And yet, the issue is that a lot of people start doing their taxes and then find that they're going to have to pay after all, because it turns out that their situation is more complicated than a simple return can handle.
Now, as part of the Inflation Reduction Act, the IRS is launching its own direct file tax filing platform at no cost. But it's just a test for now. Only 12 states will have access to this option this year, and it's expected to be available in mid-March. No matter how you file, it's always a good idea to be up to date on the latest information from the IRS. For example, things like tax brackets and standard deductions change each year to adjust for inflation. Now, what exactly is a tax bracket and why does it matter? Tax brackets determine how much of your income is taxed and at what rate. For example, let's take a look at a single filer that earned $60,000 in 2023. According to 2023 tax brackets, their first $11,000 is taxed at 10%. The next bracket goes up to $44,725, and that's taxed at 12%. Then the remaining $15,275 of their salary falls within the next tax bracket at 22%. For 2024, tax brackets have gone up about 5.4%, so the first bracket closes at $11,600. This increase means more of your money stays in lower tax brackets, which can help offset the effect of inflation. Deductions also play a big role in which tax bracket you fall into. A deduction is any expense that lowers your taxable income, like medical expenses, investment losses, student loan interest, property tax, and even gambling losses. When you file taxes, you can either itemize all of your deductions yourself, which can take a lot of time and paperwork, or you can opt to take the standard deduction, which 90% of taxpayers do. Just like tax brackets, the standard deduction changes each year to adjust for inflation. In 2023, the standard deduction for single filers is $13,850, and for 2024, it will be $14,600. So let's say that same single filer in 2023 decided to take the standard deduction. They would automatically subtract $13,850 from their $60,000 earnings, bringing their taxable income to about $46,000. Now, instead of around $15,000 being taxed at 22%, less than $2,000 is taxed at that higher rate, keeping more money in their account. Another tax rule that has adjusted due to inflation: capital gains. Long-term capital gains, or income you've received from assets like investments or real estate, are taxed at either 0%, 15%, or 20%, depending on how much you've earned. Those rates are staying the same, but the threshold is moving up. In 2023, up to about $44,600 of taxable income would have a 0% rate, meaning they would skip capital gains tax. In 2024, that threshold goes up to around $47,000. Tax time can be confusing, which is why it's always a good idea to keep an eye on new tax laws and have records of your expenses. And if there's ever a time to reach out to a financial advisor for specific questions or concerns, it's now. If you want more content like this from MarketWatch and the Explainomics playlist, please subscribe and keep checking back for new videos. We'll see you next time.